Welcome to the lecture number 4 of this accounting course. Let's first recap what we have learned in the first 3 lectures. In the first class, I discussed with you the content of this accounting course. We will be learning basic concepts, accounting cycle, financial statements, bank reconciliation statement, rectification of errors, and bill of exchange. Then I requested you to have these 3 items while you attending the class: a calculator, a notebook, and a pen. Then we discussed 5 elements, 5 basic elements of financial accounting with the examples. These elements are income, expenses, assets, liabilities, and owner's equity. Then we discussed the types of business: sole proprietorship, partnership, and joint stock company. Then in the second lecture, we explored some accounting concepts, which includes purchases, cash purchases, credit purchases, purchases return, purchase discount, and sale discount, allowances, sales, cash sales, credit sales, sales returns, trade discount, debtors, creditors, cash discount. Then in third lecture, we explored some more accounting concepts. For example, separate legal entity, which means that the business is assumed to be a separate legal entity independent of its owners. Then we explored the going concern concept, which means that the business will continue to operate in foreseeable future. Then we discussed monetary measurement, which means that a transaction can only be recorded if it can be expressed in monetary terms. Then we discussed the cost model. Every transaction is recorded at the price paid for it. Then we discussed matching principle, which describes that expenses should be offset against the revenue in the same period. Then the realization concept, which says that the sale must be recorded when goods are actually delivered to the buyer. These were our 3 lectures. Now let's start today's lecture. Today we are going to discuss a very important topic, the base of the accounting. Which is called financial transaction. The question is, what is financial transaction? Now, why this definition is important for us to know and understand that in financial accounting, what we do, we always record every financial transaction in our books of accounts. So we must understand first what actually the financial transaction is. If you are new to the accounting, it is very important for you to understand the financial transactions. So let's begin. With another definition. If we go just before the transaction, the definition of transaction, we must understand that what is an event. In ordinary language, event means anything that happens. Human life is full of events, so many events take place in the family and social life of a person. There are two main categories of the event. Number one is monetary event, and the number two is non-monetary event. Monetary events are related with money. For example, which change the financial position of a person are known as monetary events. For example, you do daily shopping. There may be some marriage ceremony. There may be a birthday anniversary, marriage anniversary, etc. All these events involve the monetary aspects. We spend some money, we receive money, we give money. So this is the monetary event. And what non-monetary event? Events which are not related with money, that is, which do not change the financial position of a person, are known as non-monetary events. For example, winning a game, delivering a lecture in a meeting, etc. Now, in business accounting, only those events which change the financial position of the business and which call for accounting are recognized as events. In other words, all monetary events are regarded as business transactions. So, the definition of the financial transaction is every monetary event is a financial transaction. Okay, any event which involves money, any event in which you give money or you will give money in the near future, or in which you receive money, or you have received money, or you will receive money in near future, is called financial transactions, and we record in the books of accounts only the financial transaction, that is the monetary events. Non-monetary events are not recorded in the books of accounts. So this is the first rule, that we only record monetary events in the books. So there are two features. Or you can say there are two conditions which make an event a financial transaction. Number one is the event must be measurable in monetary terms. And number two condition is the financial position of the entity must change as a result of that event. I will discuss in detail in the following paragraphs that what is meant by a financial position. So now let's try to understand this concept with the help of examples, some examples. Number one example is Mr. A started a business with rupees 50,000. Now let's try to evaluate these two conditions on this example of Mr. A. It is a financial transaction. Why? Because it changes the financial position of the business. Cash increases, cash is an asset and it increases and by cash increases by rupees 50,000, and owner's equity also increases by an equal amount. So this is the second condition, that the financial position of the business is changed, and the first condition that it involves monetary aspect. So rupees 50,000 is a monetary item. So both conditions are met here, and we can say that this transaction is a financial transaction, and we are bound to record this transaction in the books of accounts of the business. Please remember that this transaction, we are discussing the concept of separate legal entity, and we are taking the transactions from the point of view of the business, not the point of view of the owner. So in the books of the business, cash is increased and the owner's equity is also increased. Okay, now let's consider another example. uh, the business purchased furniture of rupees, let's say it's 15,000. Now you can say that this transaction also involves a monetary item, and it changes the financial position of the business. Why? Because the business purchases an asset, furniture. So an asset is increased in the business, and he pays rupees 50,000. So the other asset is decreased. So the financial position is changes. So that is classified as a financial transaction. Now uh, let's take the third example, which is the business submitted a tender for goods worth rupees 100,000. Now let's check this transaction on the definition of the financial transaction. If you don't know what is the tender, let me tell you in simple words that a tender is a proposal which is usually submitted to some government department to supply the goods to that government department. This is a mechanism of any government in which a government department which requires some goods, they call for a tender. In simple words, they ask the businesses in the market to submit their proposal in which they offer their price for the material and some other conditions. And the government then decide to which business she wants to award the tender. So this transaction says that the business submitted a tender. That means that the business submitted a proposal for the supply of the goods to the government department worth rupees 100,000. Now you can see that this transaction does not involve any monetary. This transaction actually involves a monetary aspect because it has a value of 100,000, but it does not result in a change of financial position of the business, because nothing is going out of the business and nothing is coming in the business. So this third example is not a financial transaction, and as a result we are not required to record it in our books of accounts. Now let's discuss the fourth example. The business appointed a cashier on a monthly salary of rupees 50,000. This transaction also has a monetary aspect of rupees 50,000, but this also does not change the financial position of the business, as it is merely the appointment of the cashier. The company has not paid him yet. The company will pay him after the 1 month of his job. So at this point of time when he or she is appointed, it's not a financial transaction and we are not required to record it in our books of accounts. Okay, now example number 5. After 1 month, paid rupees 50,000 salary to the cashier. Now you can see that this transaction involves the financial aspect, and it also changes the financial position of the business as the cash goes out of the company. So this fifth transaction is a financial transaction and we need to record it in our books of accounts. Now come to the sixth example, which is the owner took away goods of rupees 5,000 for his personal use. This transaction qualifies on the definition of financial transaction as it has a monetary aspect and the financial position of the business is changed because the goods has gone out of the business. Now let's discuss the example number 7. paid salary of rupees, let's say 10,000. It's not a salary, actually it's a commission. To a salesperson. This transaction also has a monetary aspect. It involves money, and it also changes the financial position of the business. As you can say that the rupees 10,000 goes out of the company. So it is a financial transaction. Now I am going to put the last example for you to decide whether it is a financial transaction or not. The owner paid house rent of his house of rupees 20,000 out of his pocket. Okay. Now this is the question of today's lecture for you to decide whether it is a financial transaction or not. You need to write the answer in the comment section. I am going to highlight it here with this blue color. So this transaction will also clarify the concept of separate legal entity which we discussed yesterday. If you can figure out the separate legal entity concept, you can figure out this transaction as a financial or non-financial. Okay, so this is the lecture of today. In today's lecture we discussed a concept which is very important, and the concept is financial transaction. What is financial transactions? Okay, there are two conditions for a transaction to be qualified as financial transaction, which are as follows. The event must be measurable in monetary terms, and the financial position of the entity must change as a result of that event. And later I have written some examples, and I have placed an example for you to solve. Let me highlight this two for you. So these two conditions are necessary to be met. Okay, so that's it for today's lecture. Do join me for the next lecture tomorrow, Sunday the 17th of the August. Until then, goodbye and take care.